Welcome everyone to week 3 for the ARM 54. Tonight we'll be covering chapter 4, which is on operational, financial, and strategic risk. Just as we normally do for each session, we'll go over the educational objectives. And chapter 4 is a little bit more challenging. For the most part, it's fairly straightforward, but usually where I start losing people is when we get to the financial risk aspect. And it's more of the concepts of the value at risk and earnings at risk, those type of things, and some of the regulatory capital. Some of the other stuff, when we talk about credit and market risk, I think that's fairly straightforward. So tonight we're going to talk about how we can categorize an organization's operational risk, right? So how do we put it into buckets? And so you'll be able to do that on the exam. Explain how risk indicators are used to track the level of operational risk. Again, describe financial risk and its subcategories. The next one, apply the concepts of value at risk and earnings at risk to financial risk. Now, we talked about the words means different things. So apply, that actually means doing some of the math. And so there'll be a little bit of math involved, or at least be able to understand some of the concepts involved with value at risk and earnings at risk. Explain how regulatory capital protects financial institutions from the downside of risks. And then again, apply the concept of economic capital to insurers. So again, there'll be a little bit of math, or at least some things you'll have to maybe explain the math that's going on there. And then lastly, describe strategic risk and its major subcategories. All right, so operational risk. What are we talking about here? So most times, we view hazards and operational risk as kind of separate categories, or we may talk about them as separate things. And so that, which is fine. I mean, so last week we talked about, hazard risk specifically, but operational risks really are those things of the daily activities, which include, as we talked about, people, process, systems, and external events. So the other part of when we talk about operational risk, at least from a textbook standpoint, is also looking at the positive risk, right? How can we explore positive risk while managing the negative risk? And positive risk, and from an operational sense, is how can we take advantage of just some of the different, aspects that are going on within the program. Oops. And go back here. So, might be just because of another company not performing as well, some other things to kind of capitalize on, I guess you can say, another company's misfortune can be part of that. And also the idea that the textbook talks about, it's really the operational risk is integrated into everything that a company does, all the activities. And so really, when we talk about operational risk, we really need to look at the strategic objectives, risk appetite, and risk tolerance, because it's really the daily things that the company is doing that we want to focus on. And really, what are the objectives? What's the mission, vision? And how, like a merger acquisition, how does that tie into the operations of the organization, as well as how much risk it's going to take, maybe developing a new product. And again, it goes back to the risk tolerance. How much you're willing to take, and can you sleep at night is really that risk tolerance aspect. So when we talk about the framework as we go through this, the categories we're going to focus on tonight are people, process, systems, and external events. And so when we talk about operational risk, we have the people that are involved, what are the processes, what's the steps, and we'll try to give some examples with that. The systems can be the hardware systems or the computer systems, all those, and then the external events of what goes on around us. So, when we talk about in general, traditionally, operational risk is really managed by an organization's frontline managers. And this goes back to when we talk about ERM, or enterprise risk management, is that everyone's a risk manager. So when we talk about operations, it can be the inventory, it can be the scheduling, payroll, or how many people we're going to staff. All that's really frontline managers. It's not the risk manager that's doing that aspect of it. And then the textbook talks a little bit about, when we talk about large operational losses, that really lead to us really starting to look at operational risk separate from the hazard risk, right? So some of the examples, Society Generale, their financial loss, Toyota, reputational risk and lawsuits. So the airbag issue, right? All those type of things have a reputational risk associated with. Enron, probably over 10 years ago now, right? inappropriate risk taking. And then you have examples like Kodak really failing to take the risk, right? And that goes to, what their bread and butter was. Kodak obviously was what cameras were all about. That was the film. And yet, where's Kodak now? They did not keep up with the digital aspect, and they didn't take the risk to follow that through. And so now you have all these other companies. You really don't even have film anymore, and Kodak is really nowhere to be heard of. Now, when we talk about the framework, the first area we're going to talk about is people. So within operational risk. So what does people include? Well, all employees of the organization. It can also include contractors, vendors, clients, and others. So when we talk about people risk, obviously we want to be able to hire the right people. So that's an operational risk. Do we have the right talent, skill set to be able to hire those? As well as the contractors that we're using, do they have the right skill set? Are they going to go on strike? Are they unionized? All those type of things are part of that. Now, going back to my experience working with Google, people risk was one of the main areas of concern, mainly to get talent. And so one of the things why so many companies are located in Silicon Valley is because it's attractive. Young people want to work in the Bay Area. It's very expensive, unfortunately. And so they have to find a way to be able to get them housing or affordable housing, get them to work. That's where the buses come in. So all that becomes part of the operational risk of people. The other thing that's attractive for Silicon Valley is that the employees or workers interchange between companies. As a person that has as a coder or a software engineer, basically it's easy for them to get a job from move to one company to another. So that's also that skill set. All the people that are there makes it easy to hire. Now, when we talk about risks associated with people, there's the hazard or insurable risk that we're used to dealing with, or employee injuries. We might have EPL, which is employment practices liability. So sexual harassment, those type of claims that can obviously they're insurable, but there's still reputational damage that occur from that. Resignations. When we think about people risk, we don't necessarily think about people resigning as being a risk. But the reality is that if I have a certain talent pool, and if I don't have the right benefits, those type of things, my talent, my key employees that I want to hire to make our operations better and to make more of a profit may leave the company. So resignations or people being terminated, those type of things is certainly a people risk. And then lastly, on their theft and dishonesty, right? And Wells Fargo in 2017, one of the issues that Wells Fargo had, right, was they put incentives where people were opening accounts to basically meet, some of the targets that they had within the company. The other thing about people risk, there's the main area, non-insurables, the reputational risk aspect of it, as well as, again, we talked about just having the human capital there in general. And when we talk about operational risk, the organization's culture can also influence risk-taking or avoidance. So in risk-related opportunities that manager employees do not take are not insurable. So if you think about it, different companies, the culture of going outside or kind of encouraging risk-taking. In a company like Google, they're encouraged to take risks, but usually within government, public agencies, there's a lot less risk-taking. One, because you're dealing with the public's money, tax dollars, and so you're going to have, the risk-taking and culture there is going to be a little bit different. And every company, of course, has a culture, and so part of that is making sure people that you do hire understand the culture and what's acceptable risk and what's not. So some of the strategies that talks to mitigate people risk, recruitment. So how do you hire people? Make sure that the people match the organization's needs and culture, that they have the right skill set. So one is recruiting, the selection of those people, checking references, criminal background checks, all those type of things are part of that. The training and development, right? So after we hire the people, are we training them to make sure that they can do the job? And doing it the way we want them to do it. And I would say Google and other companies that have extreme growth, one of the things they do really well is training development, especially when they're training new managers. They invest a lot of time in that. Well, with that training and development, you have the performance management aspect, right? And that's going to be your performance reviews, things like that. To have that ongoing feedback, that's an important element to help you identify issues early on. You can provide incentives. And again, that talks about incentives, can be developed to encourage appropriate employee risk-taking, as well as discourage inappropriate behaviors. Now, from a safety side, there's incentive programs, sometimes, to incentivize not having injuries at work or working safely. Those can be part of that. If you're looking for more sales, there's usually sales incentives to basically try to meet targets. All those are part of how do you encourage people to have a certain type of behavior. And lastly, the other part that they have in your succession planning, right, is that as people retire or they leave the company, is to make sure that you have someone that can actually do the job as part of that, the next level, the next generation that will be able to move on. So that's all we cover in people risk, right? That's fairly straightforward when we talk about from an operational. Now, what about process, systems, and external events? So process risk is really, it's procedures and practices organizations use to conduct business activities. And the risk occurs at the point at which practice departs from procedure. Now, an example I like to give is whether like a supermarket. Well, I like to use examples of where I used to work. And one of the challenges that you have controls in place and processes is for counting tills, right? And so you might have the cashier that will count their till at the end of the night, and they'll say how much money was in there based upon, the computer will say how much money should be in the till. But then also they're going to have another person count that money, and they'll put it in the safe. And the next morning they'll have another person usually count those dollars as well, because theft is one of the biggest issues when you're dealing with money. So part of that is, again, processes. You want to have the process and procedures in place to have in those controls to be able to identify that risk as a theft. Well, then the other part is, the risk occurs at which point people aren't doing that. They get too quick. They say, no, I'm not going to worry about it. I'll just take the till or just have one person do all those jobs. And so going to the next step, the procedures should represent best practices designed for quality, safety of products and employees. Now, the example I like to give, I already gave the cash till, counting cash tills, Bay Bridge bolt inspection process. So I don't know how many years ago it was now, but the Bay Bridge, when it was being constructed, the person that was supposed to inspect the bolts wasn't doing that appropriately. And so now they have issues with some of the bolts cracking. They're having rust issues and things like that because they went off their normal practice for quality control. Obviously, we're dealing with $1 billion bridge. There's some huge implications with that of what the lifespan will be of that bridge. And then you also have other processes, right? Overbooking of airline passengers. Why do the airlines do that? Because they know a certain amount of people will probably not go, or they'll cancel or not show up. And so unfortunately, this is the conundrum they're placed in from an operational standpoint. Their processes is then they need to deal with when people, when they actually have everyone there, or they overbook, and then what are they going to do? How do they treat the passenger, and do they have good procedures in place to deal with angry passengers and the reputational risk that goes with that? System risk. So when we talk about systems, usually we're talking about technology or equipment. So from a technology standpoint, it's the function of technology, the risks of intentional or accidental failure and security risks. A data breach can be part of that. From a technology, the internet going down in the office or servers going down, those are all risks depending on the type of operations that can either slow down an operation or completely shut down an operation. We've seen failures in technology with the airline system. Sometimes they're booking operation where if the system goes down, they can't check people in, they can't put luggage on board. So basically the planes sit idle because they can't actually check people in. So that's where systems risks and technology can have a play. Well, then we talk about equipment. Well, the failure of equipment to continue operations, this in many cases can be an insurable risk in some cases, depending on the type of equipment. But usually there's coverage for like boilers and other type of equipment that you can buy. When equipment fails, you can have potential loss of customers as well. And I think I gave this example in one of the prior classes, but Rayleigh's, when I worked there, had a distribution center and they had a battery rack. Well, essentially there was one, the picker for the batteries to be able to move batteries for the pallet jacks basically broke. And for a distribution center, the lifeblood of those facilities are pallet jacks and forklifts. And so if you can't operate those, you're not going to be able to move the product into the trucks. In this case, the the battery rack, the mechanism for that part broke, and it wasn't available. It was going to take 72 hours to get it. Well, if you can imagine a grocery store not getting deliveries for 3 days in 150 stores, that's going to have empty shelves and a huge loss. So equipment failure can certainly be, from an operational standpoint, a huge loss for an organization. And then you have all the people that are working that may not be able to work, all those type of things come into play. And then we also have external events when we talk about operational risk, right? Well, so what are external events? They can be natural disasters, right? We've had the wildfires recently, more in California, all the hurricanes, and then tornadoes, all those things certainly have an effect and have business interruption implications, business interruptions and loss of property potentially. Other external events, loss of a key supplier, right? We talked about Japan and Toyota parts with Fukushima. So when the Fukushima occurred with the nuclear event, basically they weren't able to produce the parts anymore for a lot of the U.S. car makers. So that slowed down production. So that loss of a key supplier. This can happen in other countries as well, in India or where we have some of those key parts. So identifying where your key suppliers are is part of the operational risk. Strikes or bankruptcy. So if you have a key supplier that goes bankrupt, or if they have a strike, typically on the West Coast, we've had some of our ports where the longshoremen have gone on strike, and certainly that impacts the products coming into the stores. Utility failure, right? Power supply issues. And then lastly, external events, even having skilled employees, right? If you don't have the talent pool to be able to hire from, and this, again, you want to use the technology industry as part of this with Silicon Valley, they are bringing lots of programmers from other countries, not necessarily because of pricing, it's because we're not producing enough of those type of skilled employees in the US to be able to take some of those jobs. So some of the operational risk indicators, how do we look at and identify those operational risks? Well, one of the things we want to look at is root causes, right? And so it's the event or circumstance that directly leads to an occurrence. And how you identify those root causes in many cases is like a retrospective review, right? But unfortunately, when we do those, it's probably too late to prevent, maybe too late to prevent a catastrophic loss. So the example that I gave with the grocery store with the battery rack is that they didn't identify a root cause that can have lead to a catastrophic event of having the plant down for 3 days. But be able to do that, or identifying potential losses that maybe they're smaller losses, and do those retrospective reviews to identify bottlenecks, things like that. That's really key in helping identify operational risk indicators, right? The other thing that talks about in the book is what's called a key risk indicator, or KRI. And that can be a financial or non-financial metric used to help define and measure potential losses. When we talk about key risk indicator, it must be leading, not lagging to be effective. You will most likely have a question identifying what a KRI is, and the main description in there is it has to be a leading indicator. So that's something that I would highlight. You can expect to have that on the exam. So one of the things that the book does talk about is, you kind of have this chart of progression of issues to losses. And the idea is on this, and there's kind of Heinrich's theory as well, is that a lot of times we have issues, right? It's an issue, it's a concern. Well, that issue can grow into an incident, and then where we may have a loss or not. But then finally, if it keeps on progressing, it can be an actual loss. So a lot of times we know about things early on that someone brings up that, oh, maybe the product is not turning out the way we'd like it. Well, eventually we have an incident where someone, let's say we're making pizzas, right? And the cheese, they're saying that the issue with the cheese not melting properly, making something up here. Well, eventually we have someone that returns the pizza, then that might be an incident. Well, then someone ends up getting sick, and then now we have a foodborne illness. That could be the loss. But we had early warnings on those, and so that's the idea that they're trying to show here, is that usually losses start with a progression of little things that can grow into larger things. The Heinrich's theory is kind of similar to this, and there's some within the safety community. The Heinrich theory has kind of been somewhat debunked, but the idea is that by the time before you have a fatality, you have this kind of loss triangle, and the idea is that there might have been 2 million unsafe acts at some point where people were they're doing things, they weren't wearing their seatbelt, they were speeding, all those things. Well, those things didn't lead to anyone getting killed or even an accident. Well, of those times that people weren't wearing their seatbelt and speeding, there was about 240 near misses. So maybe they had a little, maybe a fender bender, little thing like that. Well, eventually, maybe the 240,000, you had 20,000 minor injuries, and eventually of those 400 were lost time, and out of that, one fatality. So with this idea is that kind of law of large numbers, eventually those unsafe acts are eventually going to lead to something really bad happening. And again, that goes to the example that they're trying to give, is that there's little things that you can identify early, prevent those little things or those unsafe acts or those risks from occurring, identify them, and hopefully you're going to prevent the really catastrophic thing from occurring as well. So some of the risk indicators they provide in the textbook, this is on 4.9, and this is something that I would certainly take a look at. You're going to probably have something on the exam. It's a list that's part of this. And so it talks about people, processes, and systems, and what are the type of risk indicators, right? So based upon, whether you can hire people or whether your person's going to have injuries, those type of things, some of the indicators are their education level. Do they have prior experience? Employee surveys, customer surveys. Do they have incentives, authority level? All those things can be indicators. If you have those programs, you can identify those issues early on by having criteria associated with that. From processes, some of the indicators you can develop are, quality scorecards, looking at errors, identification of areas of highest risk. You can go through here. And then lastly, systems and how you test and things like that. The main point of this is getting across is that for each of these operational risk classes, you want to be able to identify what are some risk indicators that you can use in there. And so one of the first objectives we have tonight is the ability to categorize an organization's operational risk. And this is really what we're trying to do with this chart. And so this speaks right to the question of how do you organize or categorize an organization's risks. Now, when we talk about KRIs, one of the things or exposure indicators that we're talking about here, this is something that when I was with the University of California, we used as a key risk indicator. And it might be hard to see some of the different numbers, but the key point on here is that the number, one of the concerns is from human capital or people is people retiring, right? And if you look on the chart there, about on average, the blue line shows about 30% is the medical center average, and campus was about 26%. So at this point, at this snapshot that was given here, about over 25% of the employees in the UC system are eligible to retire. Well, that has huge implications from succession planning, things like that. And how do you make sure you're hiring more people and you have those things in place? And so this is something that was provided to each campus. Now, one thing you'll note, the one that's really low there is Merced. Well, that's a brand new campus, so it has a much younger population, and so they don't have as many retirees. Well, one of the things that the university was able to do through the Enterprise Risk Management Dashboard is to actually dig into the data. And so this is Office of the President data, and what it actually was a human capital index. And you can see where the bands of employees based upon age ranges are located. And you can see where the bubbles are, right? And so you can see that about 10, the number of FTEs that were over 60, between 66 and 75, there's 10. And then you have 56 to 65, 209. You can kind of see where those bubbles are occurring. And you can also notice that the percent eligible at the Office of the President is about 33%. Now, this is kind of, Office of the President is more the headquarters. It's the more the administrative background for most of the campuses. Well, you can actually dig a little bit deeper. And in this case, we're able to see the actual number depending on the departments within Office of the President. And if you look there on the next one, first was administration, but the other was general counsel. Now, if it shows that there's 20 FTE that were eligible to retire. Well, there's only about 35 attorneys, so basically 2/3 of the general counsel was eligible to retire. This becomes a key risk indicator. Understanding we need to have better succession planning. How do we make sure that knowledge? Because if all those people retire within 1 year, you can imagine the impact it would have on the organization and all the institutional knowledge being lost. So this is an example of a key risk indicator from an operations standpoint of things to look at, because human capital is one of the most important elements in an operation. Here's another one that's another key risk indicator. This is more of an opportunity for the university. This is actually one of my favorite charts because it's not dealing with losses. And this is electronic employees receiving electronic W-2 forms. And what was determined back in 2009, where they started pushing this, was that the university would save $7 million annually by having employees receiving their W-2s electronically, because there's a cost to printing them, mailing them, all those type of things, and the work, the envelopes and everything else to actually produce these on paper. And the university had about 200,000 employees. Well, as you can see, once we started publishing the numbers, this was an easy sell that, Merced, which is, again, the newer campus, they bought on this really quick, that we had some campuses where about 20% W-2s moved all the way up to, closer to 60%. So they started realizing those savings. And of course, we saw, much more immediate acceptance of electronic W-2s at Merced because it's a much younger population. They're being younger, they're more acceptable of having their W-2 electronic instead of being mailed. And so this is, again, kind of more the opportunity, looking at the positive, because every dollar spent on a paper W-2 was less money going towards the core mission of the university. So hopefully that's helpful to kind of see some of those graphs as part of this. Well, as we talk about exposure indicators, and these are some of the definitions that are in the textbook, so you want to make sure you understand what these different things are. But exposure indicator, it's a metric used to identify risk inherent to an organization's operations, right? So it's fairly basic. Loss ratio, which is normally a key exposure indicator for insurance, right? And so for those that work in the insurance industry, nothing new. It's a ratio that measures losses and loss adjustment expenses against earned premiums that reflects the percentage of premium being consumed by losses. So essentially, an easy way, it's how much money you taking in from premiums and how much money is going out on losses. That's really what the loss ratio is, but they put a lot more words into it in the textbook. And then the other one is a control indicator, which is a metric used to identify an organization's management of risk, right? And so if we're talking about workers' comp or working with a third-party administrator, we can get an idea of what's going on by looking at maybe the claim data. Part of that might be claim volume. How many claims are we having a year? Are we going up or down in those? What's our closing percentage? How quickly are we closing claims? Medical versus indemnity claims. And then 3-point contact timing. The idea of if you contact an injured worker or someone that has a claim against your organization, to have 3-point contact between the employee, the doctor, and the manager within 24 or 48 hours, they're less likely to get an attorney, and you're going to have a more successful outcome with that 3-point contact. Now, part of the goal, and they talk about, is relating indicators to outcomes, right? How do we tie these indicators, and again, hopefully they're leading to be able to tell us a story to be able to have an impact. And so the goal is to evaluate how a control indicator affects outcomes. Now, I talked about the example of the W-2. One of the things we identified, and I put some questions in there, is there a relationship between age of a school? Well, yeah, the newer school had a younger, faculty. So therefore we saw better acceptance of electronic W-2s. Is it a new policy? Do we see any correlation between younger versus older? So all these things are control indicators, and how, if we adjust some of these things, if by implementing a policy, does that make a difference? And obviously what we saw on that chart was that by instituting a policy, making something that each of the chancellors at the campuses enforced or pushed, that we saw basically change in the acceptance of that. So how can we do that? We can do that through histograms or other types of charts, regression analysis, as well as benchmarking against others, right? Whether we want to benchmark against other, let's say if we're a retail store, comparing store sales to one another, or we can do it against the industry as well. So this kind of, again, going back to the chart, what is it telling us? The W-2s, over time, which ones are more accepting? One of the things I always like to point out here, Merced does great, but if you go on the far right, Santa Barbara and Santa Cruz, a little more old school. They had very little people doing W-2s, and it's just more the culture there as well, that there's just less acceptance or more distrust of technology in some cases by the faculty there. All right, now this is also in the textbook, and they talk about risk indicators, is client complaints versus years of employees' experience. And again, collecting data, and really what the point that they're trying to show is that there is a correlation, right? That if you look at the number years of experience, if they only have 1 year experience, those in that area, we had about 50 complaints versus those with 10 years experience only had about 25 client complaints. The idea being, the more experienced the person is, the less likely that they're going to have complaints because they do have that experience. And so then they also in the textbook kind of talk about, doing a regression now. So this is just the different ways you can show. So we talked about on the prior slide, you can do through a histogram, you can do it through regression analysis, or you can do it through benchmarking. And that's all that they're really trying to show on these slides. You're not, as I put in there, required to do calculations on the regression for this type of part, but it was just kind of showing you that there's different ways you can look at the data and basically tell a different story. And again, then you have benchmarking data on the last one. Really wouldn't expect really any major questions other than if they give you a chart to be able to explain what it's telling you, what the correlation is between those. All right, operational risk, done. So now on to financial risk, right? So when we talk about financial risk, the three major types of financial risk that we'll be talking about are market risk, credit risk, and price risk. Now, and then there's also, when we talk about financial risk, there's two main characteristics, right? External risk with the potential to affect an organization's objectives, and the risk can be reduced through financial contracts such as a derivative. They used to focus a lot more on derivatives in this textbook. Luckily, they've gone away from that. But again, the characteristics of these are, a lot of times when we talk about credit, price, and market, these all can be impacted really by external events, right? Interest rates, you can't control that. Stock market, the bond rates, inflation, all those things have an impact on basically on all these different prices, right? Price risk and credit and market risk. So when we talk about financial risk, really the goal is risk optimization. We really want to try to protect against the downside risk, right? And we want to capture the upside risk. So this also goes into diversification. When we talk about our own retirement accounts or financial aspects, is you're really trying to protect against downside. If something goes down, that you're going to have, whether that be a stock goes down, well, maybe a bonds that might be going up, or you diversify, or if it's certain commodities, let's say like oil, like for airlines, they can hedge and basically protects against rates going higher as well. So risk optimization. And so one of the questions you'll probably have is something like one of the goals of financial risk, and they'll have a question regarding risk optimization. So their definition they provide is a state whereby risk and return are balanced so that a maximum return is achieved for the level of risk accepted by an organization. Now, again, I'd like to give the example when we talk about risk optimization is that you could buy a whole bunch of lottery tickets And there are stories about when, the recent lottery that went to what, $1.8 billion that was available, that some people bought $20,000 worth of lottery tickets and of course didn't win. And so that wasn't really good risk optimization to be able to do that. They took on, the maximum return. They didn't achieve the level of return, and they took on a huge risk by having all those dollars go out. Same type of thing when you think of your retirement portfolio. If you're investing, you're trying to optimize so that you have a certain level of return based upon the risk that you're willing to take. As you get older, you're going to be a little more conservative in what type of investments that you're going into, and so that's part of that risk optimization as well. So the same thing occurs for companies when we talk about this. The other aspect to think about is hedging. And really what hedging is, described a financial transaction of which one asset is held to offset the risk associated with another asset. And these are really futures contracts, and then what they also talked about are credit default swaps. But the main thing we're going to focus on is really futures, is that you're buying at a set price with the idea that if it goes up, you're going to still pay that same price, where your loss area that you'd have if price goes down, you're going to pay a little bit more, but at least you're not going to pay more than you would have before. Hopefully that makes sense the way I described that. And then market risk, right? So when we talk about market risk, really what we're talking, it's risk arises from the changes in value of a financial instrument. And it talks about systemic risk is risk that is common to all securities of the same general class and therefore cannot be eliminated by diversification. So when we talk about market risk, again, the value of that can be affected by currency price, interest rates, commodity price, equity price risk, and liquidity risk. So all those things are categories under market risk. And so when a company, and I can use Google, operates in other countries, a lot of times it's based upon the US dollar, depending on if the dollar is weak or strong, actually has an impact when they have sales in these other countries because of that difference. And so that's the currency price risk that they kind of take into account. So where you're buying the product and what currency you're using certainly has an impact on an organization. Interest rate risk, right? Right now we've been rock bottom, almost 0% interest for so many years, and now the Fed is now increasing interest rates very slowly. But that also has an impact on the cost of borrowing to be able to pay things back, right? And so we'll kind of go through a little bit more in detail. So currency price risk, what is that? It's risk related to changes in currency exchange rates of countries, but you can hedge that risk by procuring locally, right? So buying the product there, you're paying with those dollars, and you're going to have less risk associated with currency price. Interest rate risk, risk that a security's future value will decline because of changes in interest rates. Now, how, it talks about in the textbook, swaps can be used to hedge against interest rate volatility. And basically a swap is an agreement between two organizations to exchange payments based on changes in the value of an asset, yield, or index. You're probably not really going to need to focus on that too much, but that's just something that's talked about in the textbook. This is a fairly large chapter, so you're probably going to get 10 questions total, but you just want to know what these things are. And basically in the text and the educational objectives is really be able to describe financial risk in its subcategories. And so we're identifying market risk, and as part of this, interest rate risk is a subcategory. When we talk about interest rate risk, where this comes into play though, and this is what it talks about, insurers can be vulnerable, and it's because they typically use bonds with durations linked to expected payments, and then earn much of the income from investment returns on reserves. So said that fast. What that means is that when I buy an insurance policy and everyone else buys an insurance policy, what the insurance company does is takes that money and now invests it in various types of bonds or other instruments and stock. And they try to be fairly conservative because they want to make sure that they're going to have repayment. And we'll talk a little bit more about, securitization as well later on in the chapter. So the way most insurance companies will make their money is they make their money off the investment of that, let's say, $10 million. And if they make 6%, right, then that's all profit for them. But what happens if interest rates, and especially on these bonds, and there's a payout schedule. Workers' comp is usually over like 7 years. They're expecting they're going to have these bonds come due every month. It's like a stair step. Well, if the interest rates change, what they expected to make off of these things may affect their bottom line profit. So if interest rates go down and they're not making as much money, and they continually buy, so after they get the money, they reinvest in the bonds, and that goes down. That's where it's going to affect their bottom line profit. So that's where it can impact an insured, as well as it talks about, really, it's the reserves. It talks about the investment returns on the reserves. And so again, that's because they have to hold the money to make sure they have enough money to pay for the claims until all the claims are closed out in those years. When we talk about interest rate risk, we're also talking about cash matching, process of matching investments maturity value with the amount of expected loss payments. And this goes what I was talking about is kind of with the maturity that we want it to come due when the actuary says we're most likely going to have the payments, so we can maximize the amount of time that investment is earning money. Zero coupon bonds, a corporate bond that does not pay periodic interest income. And it just talks about, these are just some of the things that are in there. And reinvestment risk, and that's the risk that a rate at which periodic interest payments can be reinvested over the life of investment will be unfavorable. And that reinvestment risk is the bond comes due, I get the money, now I'm going to reinvest it, but it's a lower interest rate than I had before, so I'm actually losing money by that because of the maturity of the prior bond. And the last thing when we talk about market risk is commodity price risk. This is risk associated with a change in the price of commodities that are necessary to an organization's operations, right? So oil, or gas or fuel, typically oil prices go up. That impacts plastics organizations, that produce because they use oil, jet fuel, transportation, all those type of things can be impacted based upon commodity price risk, specifically as an oil an example. Commodity price can also impact cash flow, and to make sure that, again, we have money to pay for those, because if we're spending more money on oil or fuel, that's taking money away from the liquidity to do other things. And then also part of what we do when we talk about commodity, there's actually futures contracts. And so that's really when we talk about what Southwest does or other organizations, they're going to buy a futures contract, and that's really a form of hedging, is basically accepting delivery of a specified quantity in jet fuel on a given date, but we have a price that's locked in for that. And so that's really what we talk about commodity pricing. Equity price risk. So equity, so what exactly is that? A risk that changes in price of a stock or another security will increase or decrease. So when we talk about equity, we're really talking about stock prices, right? And it can be classified as following: related to an organization's share price. So what we're selling at, how much money that people are investing in our company by buying the stock can be an impact. It's also risk related to organizations' investments in external stocks and other securities, as well as risk related to average share price in a market or market sector. But the main thing to think about equity price risk is you're dealing with the stock market. And with that, you can have a call option or a put option. You do want to actually know the difference between those. I remember this being a question on the exam. What's a call option? It's an option to buy at a set amount of an underlying security at any time, whereas a put option is an option giving the holder the right to sell at a set amount of an underlying security. So you want to know the difference between a call and a put option, because that's typically on the exam. And we also have liquidity risk, right? So liquidity risk is organization's liquidity is related to its cash or ability to raise cash. So when we talk about liquidity risk, is how much can we convert assets into cash to be able to pay, or having a line of credit. And so some of the liquidity risks they list is, possibility that large numbers of clients could withdraw funds, so if you have a run on the bank, so to speak, as well as possibility of line of credit being available or revoked. And so really the ability to have access to cash when you need it, that's something that's important for organizations as well as households, right? You want to have certain assets that are liquid. Credit risk. When we talk about credit risk, we're really talking about risk that borrowers will not pay back a loan. Well, we had this in the mortgage crisis in 2008, is that people had loans that they couldn't pay, and which then also caused the whole disruption in the financial market. When we talk about credit risk, it only has a downside or negative potential, and it's really inherent risk for financial institutions. So any like a Best Buy or any of those companies that, or mattress, right? Anyone that extends credit, part of, over a long period of time, 5-year repayment, or cars, things like that, they run a credit risk that they won't be able to pay back the loan. And at least in a car, they can basically, get the car back, right? As collateral. But for other things, they may not be able to do that. And that's why also the higher, like a personal loan, if there's no asset tied to that, like even like a mortgage, those type of things, that also means a higher interest rate that people will pay. So that's what credit risk, when we talk about it from, at least for the textbook standpoint. Actually goes a little bit further. Credit risk, 2 types of credit risk: firm-specific credit risk and systemic credit risk, right? So the firm-specific can be, through diversification. How do you reduce it? Of type and duration of credit used. How we evaluate creditworthiness, right? Are we going to extend credit to that new company? Or am I going to give a loan? Those type of things. That's part of like doing underwriting. And you can transfer some of the risk by selling loans to other organizations, right? So what typically happens in the mortgage industry is that they will obviously write loans, but then eventually they may sell some of those loans to other organizations and let them take on that risk associated with whether they're going to get repayments. Systemic credit risk is caused by the selling of loans to other organizations with poor underwriting. And so that's what we had in 2008. And it's, the only way you can manage that is really through the regulatory oversight of putting in requirements of what lenders, criteria of who they can provide loans to, things like that. So that way there's not poor underwriting of having people that couldn't afford the loan in the first place. And then we have price risk. So price risk is potential for a change in revenue or cost because of an increase or decrease in the price of product or an input. So when we think about, this kind of goes back to somewhat commodity, but if the price of raw materials goes up, that obviously will impact the cost of the service or the product. If the minimum wage, there's always the argument, well, if there's a change because of the cost of, minimum wages increase, well, does that going to cause an increase in the price of the service? Tariffs can also be part of that now because there's an increased cost associated with that. So that's where the price risk comes into play. And also, what is the price of assets purchased or sold by the organization? So how they price the market, all those things will certainly have an impact on price risk. All right, now the fun part. Value at risk and earnings at risk. Like I said before, this is typically where I sometimes lose people. The good news is that you're not going to have, too many questions. You'll probably have 1 or 2 questions, and it's actually going to be dealing more with the math aspect of it, and or at least how to understand the graphs, and we'll go through that. So, but it's important to understand what the definitions are and what they actually mean and how they apply on the financial standpoint. So earnings at risk, it's a maximum expected loss of earnings within a specific degree of confidence. And when we think about a distribution graph, right? And if we have, the confidence level of 95% confidence level, things like that, that's a maximum expected loss of earnings within a certain degree of confidence. And we'll show some graphs on that as we go through. Value at risk, or VAR, measures the probability of loss of an investment's value exceeding a threshold level. So the key benefits of this risk measure is that you can have a look at a potential loss associated with an investment, that you can actually quantify it a little bit, that complex positions are expressed as a single figure, and that loss is expressed in easily understood monetary terms. These are some of the benefits. It's a list, so you're most likely going to have a question dealing with some of the key benefits of using a VAR. Some of the limitations, though, is that it does not accurately measure the extent to which a loss might exceed the value at risk threshold. And when we go to the graphs, you'll understand what I'm talking about when we talk about the limitations here. So if you look on this graph, talks about the measure of a value, probability of a loss of an investment's value exceeding a threshold level. In addition to working within a short time horizon, VR is typically characterized by low probability. And so the example they're giving is a 1 day, 5% value at risk of 300,000 means there's a 5% probability of losing $300,000 or more over the next day. So all this is doing, and if you get a chart, is if you have your 95% confidence level, and what's saying is at 5%, that marker right here is we're looking at $300,000 of loss. What that's and this is where the challenge that comes with this is at least you have a 5% chance of losing at least $300,000 or more. You could lose $600,000, right? So, but we know there's a 5% chance at least 300,000. And if we go here, maybe it's closer to there's a 2% chance of losing 600,000, let's say. So you can kind of have a marker. That's all that they're really asking for on this, is just to understand how a distribution is used. You're not going to have to do any calculations per se on this part. When we talk about earnings at risk, it's used primarily by non-financial organizations to model the effects of changes in various factors of their earnings. So they can look at price of product sales, price of commodities, or production costs. And it's also based upon a specific confidence level and distribution curve. Now I throw this in here. This is an old chart that they had from way back when, but the idea is when you look at the confidence levels, one of the things you need to keep in mind is at a 95% confidence level, that means there's 2.5% on this side and 2.5% here. Or if they say 99.74, basically it's what's this called? There's almost like a 0.5% on each side. Or excuse me, here we go, 2.15% on each side at this level, and you can kind of get an idea of where these things come into play. So when we look at the distribution curve, in this case, it is still showing the 95%. In the example, if the ER earnings at risk are $100,000 with 95% confidence level, then the earnings projected to be 100,000 or greater is 95% of the time, and less than 100%, less than $100,000, 5% of the time. So whereas variation looks at value at risk, really at the losses, earnings at risk is really looking at how much the earnings can be. So that's where you want to differentiate between the two. Value is really dealing with losses, while earnings is really what the projection of 95% of the time you're going to make at least $100,000. And only 5% time you're going to earn less than that. Again, they kind of make it more complicated in the book, but that's basically all that we're talking about when we talk about these graphs. Now, this is where you'll probably get a question. And this is where hopefully this will make this fairly clear for you. So what makes this difference is you'll probably get a chart and they'll say, what is the value at risk based upon this level and explain the 5% value at risk amount in words. So 1%, well, this is easy. We can say value at risk at 1% probability is $400,000, right? Now, if we say 5%, most of the time you're probably going to say, well, 5%, it's $100,000. But that's actually not the right answer, because what you actually have to do is add these up. So you have a 1% plus 2 is 3 plus 2 more is 5%. So at 5%, it's $200,000 is the value at risk. And at 10%, because 5 plus 5 is now this. So if we go on the next chart here, you're going to see exactly what I was talking about. The question you're going to have on the exam is basically this type of example, most likely. It's going to ask you to say, what's the value at risk? And it just wants you to make sure you can apply that knowledge to basically say what is the actual value and not just look at the number. And so the question is to put in words, there's a 5% chance that the portfolio will lose 200,000 more of its value. So let's go back. All right. So 200,000. And there we go. There's the 5% at risk. So, and within, there's also some practice also in the supplemental materials that's on the website you can use as well to help you learn this a little bit more. The other major area on here is explain how regulatory capital protects financial institutions from the downside of risk. Well, and this is really the first part, but regulatory capital is the idea of, again, regulations that government is prescribing certain capital requirements, right? And the idea being that, the too big to fail, they want to make sure banks and insurers have enough assets to be able to pay for claims or all the loans that are out, that if they had a run on the bank, do they have enough money to withstand, or bad loans to basically be able to pay those out. So when we talk about this, capital is the accumulated assets of a business or an owner's equity in a business. Risk capital is the level of capital required to provide a cushion against unexpected loss of economic value at a financial institution. So, risk capital, we'll talk a little bit more about that. Then there's equity capital. Again, equity refers typically to stocks. And so equity capital is the preferred stock, surplus, common stock, and other capital reserves that are not available for sale. And then leverage, they talk about the practice of using borrowed money to invest. And that was the major factor in the 2008. So if we leverage the assets, and this is what was happening in the banking industry, is that the banks were essentially buying these derivatives using borrowed money. Essentially, the banks, we put our money into the bank and savings and all those type of things, and they use that money to provide loans. Well, in this case, they also use it to invest to hopefully make more money, and then they lost that. So they were leveraging the assets that they had that was within the banks. So what this graph is basically showing, when we talk about risk capital and then economic value and loss of economic value, kind of this threshold, is that if we have a loss, here's the amount of money, the required risk capital that we should have. And this says the shaded area, the required risk capital, represents a confidence interval of 95%, that a loss of economic value will not be below this range, and the tail risk represents a 5% risk of loss beyond the level of required risk. So when they talk about this 5%, they're not showing it, that this shaded area, this is 95% confidence level, we're going to have enough money for all these type of things, and there's a 5% chance right on this other side that's unshaded that we'll have a loss because we don't have enough required risk capital. Regulatory capital, again, talks about the United States. The Bank for Insurance Settlements implemented 2 risk-based capital ratios, and they have Basel II. The main thing to get out of this, between Basel II and these others, is that there's certain criteria that they want to put in place of risk-based capital, how much money, so RBC, that these organizations need to maintain. And some of that, and also understanding that the capital that they have on hand has different capital, can be impacted in different ways. And so when we look at some of the pillars on the capital requirements, you have credit risk capital, right? This is some of the standardized type of credit risk that they would have of people being able to pay. You also have market risk capital. That's another, which is the value at risk. And then you also have operational risk capital. And so it was really combining these different tiers of how much money you should have, because one area may impact another area as far as losses. And so, again, the type of loans, there's more credit risk associated with different type of loans that are given, and repayment schedules, and there's systemic risk. All those things are part of the whole regulatory capital requirements. You're not going to have to really know Basel II and all this other stuff in here. The main point is just understand that there's regulatory requirements that have risk-based capital as part of that, and be able to explain that aspect of it. And then also, and just understand that B for banks, again, we talked about that, introduce these additional capital requirements. And part of the reason why, improve risk management and governance, transparency, disclosures, and again, create a capital requirement or surcharge for large global systemically important banks. And some of these things are still being implemented now. And so it indicates by 2019 that has to be implemented globally. So we talk about risk-based capital requirements, and this is specific for insurers, and this is where the solvency comes in. So just like banks, where they can have they had bad investments, insurers are also required to have capital to pay for, claims or in policyholders. And so the whole idea of the insurer's capital, as it talks about, is to enable it to meet its obligations to policyholders, claimants in the event of unexpectedly poor investment performance or underwriting result. Underwriting results meaning they had a lot more losses than they anticipated. For most, it talks about RBC for Insurers Model Act, pretty much adopted in most states, enables insurance regulators to take action before an insurer becomes too financially weak to be rehabilitated. When we talk about Standard & Poor's or Moody's ratings, is it a AA rated, all those things, all that is part of the credit rating to say whether this is a company is financially stable, good underwriting, do they have enough assets to pay for claims. That's why it's so important to make sure that you actually pick an insurer that has good ratings. That goes right back to this capital requirements. So the main components of the RBC formula is asset risk, credit risk, underwriting risk, and then action levels. So we're going to talk a little bit more in detail about some of these things. When we talk about asset risk, what is that? It's all the assets that are exposed to asset risk or risk that the asset's value will decrease, right? So when we think about an asset, that could be a home, it could be a vehicle, all those type of things. So what's the asset that's exposed to risk? Or it could be a commodity, right? Or stocks. Change in assets values reflect in policyholder surplus. Some examples include fixed income assets, bonds and loans, as well as equity, which would be stocks. And the riskier the asset, that means you have to have more underlying capital. And then you also have, again, the credit risk, underlying underwriting and action levels. So credit risk reflects the possibility that the insurer will not be able to collect money that it's owed. So most of those talks about where we have sources of that: federal income tax recoverables, interest, dividends, and real estate income. And each asset is multiplied by a factor to determine credit risk. You're not going to need to know the formula other than, or do the calculation, but you just need to understand how these different things come into play and what the action levels are. Then underwriting risk, it's a risk of loss if it collects insufficient premiums and or significantly underestimates its loss reserves, right? So if we, we think we're going to have for hurricane season, we have insurance, we didn't collect enough money to pay for all the claims, that becomes underwriting risk. The RBC formula applies factor based on different lines of coverage to reflect industry experience. So property risk is going to be different from workers' comp compared to general liability, and then also takes into account excessive premium growth to account for price cutting. Now, premium growth meaning that that you're writing more. I won't say writing more policies, and you're seeing that growth. So there's a formula that takes that into account. They talk about, and then the action levels. Results of the RBC formula determine action to be taken. So basically, if you have 200% or more, risk-based capital, meaning you have plenty of money on hand, essentially almost double of what you're required, you don't need to take any action. You're good, right? Because you have enough capital to be able to pay for claims. 100 to 200 may need to take corrective action. If you're 70 to 100, placed under regulatory control %. And essentially, what we're saying is, 70 to 100 means that they don't even have enough, based upon their exposure, enough money on hand to be able to pay for the claims. 100 to 200, for the most part, they probably are. Obviously, the closer to 100, the worse they are. But if they have 2%, they're fully capitalized. There's plenty of money to pay for claims. And that's really the main takeaway from this in the RBC formula, is not to understand actually doing the calculation, but understanding what it means from an action level standpoint. All right, economic capital. So when we talk about economic capital, to mean, now with solvency and others, it's a global standard for capital required for insurers, and it's based on the fair market values of the firm's assets and liabilities, as well as their variability. It's not based on a formula, right? As far as doing all these calculations. And this is in the book. I think it's a good description of it. And the idea is that if you're 99.5%, of the time, or if you have a 99.5% confidence level, that essentially means with the number of assets, you're going to only have 1 out of every 200 years where you may not have enough money to pay for the claims, which means on the other side talks about that if you have $50 million cash on hand based upon this economic capital formula, that 199 out of 200 years, you're going to have enough money to be able to pay for all those claims. That's really all that we're talking about when we talk about economic capital and the kind of the formula that they're using in here to kind of the takeaway from it. So fair market accounting, they talk a little bit about this in the book as well. And the idea on this is that there's a fair value is a market-based measurement based upon the price the asset owner would receive by selling the asset, or that a liability holder would pay to transfer the liability. So kind of going back to the mortgage industry or other assets that they might have, is what is the fair market value of those assets? And that's all when we talk about fair market accounting is, what is the value, because that can go up and down depending on interest rates or the industry, those type of things. Talks about the fair value can be influenced by a couple different factors. Cash flows and risk attached to those cash flows. And the example they give is, present value of a bond held by you and issued by an organization in financial difficulty, right? So that if you have a bond, let's say even a corporate bond, let's say Sears. Sears is in financial trouble. They're going bankruptcy. If you have a bond, well, the credit rating might not be poor. You're never going to see that money back. So having those credit ratings in the asset, while it might have been good at one point, if that bond or other instrument is failing, it's really based on that you need to take into account the fair value of that. And so over a period of time, as an insurer, if they're investing in these different instruments, this is how this fair market value comes into play. Understand that GAAP and SAP are used by insurers, but may use non-market values because of depreciation. Probably not going to see much on there. So the fair value of insurers, the other thing is also, when we talk about assets, there's also the kind of the fair value of the claims, right? Of what the value or the incurred but not reported type of value on reserves, if they weren't, of the liabilities that they have on the books, right? So we need to have the fair market value of the liabilities just as much as we need for the assets. The challenges it talks about, it's difficult because no market exists for trading loss reserves and unearned premium reserves, right? The unearned premium means you're going to collect that premium the next year to help pay for claims. There's no market for that. Some of the challenges because of that, reasons why, reserve estimates are uncertain due to future loss payments and timing of those payments. From a workers' comp perspective, you might have, let's say, a back injury claim, and it's just a strain. It's reserved at $10,000. Well, eventually, something happens where the person needs surgery. Now it's a $500,000 claim. That's where we talk about the uncertainty of reserve and estimates and the future loss payments. It's difficult to transfer reserves to reinsurer or another party at present value. So like what's called a loss portfolio transfer at LPT. There, a lot of times what's called selling your tail is you can try to sell your losses to kind of get those off the books and to clear your plate. But what you're actually going to do when we say transfer, you're actually going to pay them to take those claims for you. And usually there's a premium associated. So if the total market value today is $2 million to basically sell those claims, they're going to say, well, just because of the risk that these can go up, we want $3 million. So that's the challenge of transferring some of those. And then that's where the risk premium comes into play, or risk margin or market value margin. It will require additional payment for someone to take those on because of the fair value of those. So we talked about, this is again, graphs I think are the easy way to be able to explain what's going on with these. And so what we have, so here's the fair market value of assets. So this is what we've invested in. This is the dollars, right, that we've collected, our premium, and anything we invested in, what the value of those are. And they should, hopefully we have more assets than we do on the liabilities. And then here's on the liabilities and market value surplus. So we have excess capital, we have economic capital, and then we have market value, and then this is what we call market value surplus, right? This is our cushion on some of the economic capital. And then here we have our present value of liabilities. This is in this whole thing, the market value margin of what it would cost essentially to eventually pay those off. So that's where we have the fair value of liabilities. And so when we add those two up, and this is the whole liabilities and market value surplus, you're going to see a formula here in a minute of how we calculate market value surplus, because this right here is what's important, and this is what you're going to have a question on the exam about, and they'll give you the data to be able to do that. So, to calculate fair market value of an insurer's reserves, estimated future payments are discounted to present value, and a market value margin added. They will, actually, I don't think they give you the formula. You're going to have to memorize how MVS is calculated. And so it's basically market value surplus. And all that equals is fair value of assets minus the fair value of liabilities. Fairly straightforward. So just, almost like a loss ratio. Now, the only difference is that when you do the fair value of liabilities, they're going to present it as what that equals is the present value of liabilities plus the market value margin. So here's an example of a question that you might get. There'll be and a lot of times they'll throw in some just dummy numbers in there to kind of confuse you. So in this case, Autumn Assurance Group has assets at a fair value of 100 million. Okay, so that's going to be in our first bucket. The present value of Autumn's liabilities is 85 million. The market value margin is 5 million. And using probability models, Autumn determines its value risk is 8 million and expecting to incur 8 million or greater loss of capital at 0.5 probability. So there's some extra numbers that really don't mean anything. So, but this is what you're going to have to decipher when you get a problem like this. All it's asking for is a fair value of assets, minus present value of liabilities. And so when you look at that, we're talking about as 100 million, which we saw before, right, is the fair value. And then the liabilities is 85 plus the 5 million. And so if we do that's 90, 100 million minus 90, it's 10 million. So the market value surplus is $10 million. That's what you're going to be asked to do on the exam. And there'll probably be one question dealing with that. And you just have to memorize the MVS formula and just be able to pick out the numbers in a word problem. And so last couple items on here is economic capital for insurers. What does that mean? Basically, economic capital, again, form of regulatory capital is estimate of capital for needs to remain solvent at a given risk tolerance level. And sometimes the economic capital will be determined by a regulatory body. And so this is where, in the textbook, you'll probably have, I think there's a question on here, apply the concept of economic and capital to reinsurers. This will be part of it. The MVS, the underlying paradigm of economic capital is similar to insurers' risk-based capital. So economic capital and risk-based capital, kind of the same things. Both attempt to quantify the various risks faced by an insurer, such as market risk, credit risk, liquidity, insurance, and operational risk. So why is this important? Is because it has to take into account and quantify some of these risks that are part of this. And that's the main thing you'll get on a question here on this part of the exam. And what's also trying to show when we talk about MVS, if an organization's market value surplus is larger than its economic capital, then it has excess capital. If its MVS is less than its economic capital, a deficiency exists, right? So in here we have, the threshold value. Here's our economic capital and amount of profit or loss. So gain or loss on market value surplus. And obviously we want to have more money so we don't have a loss. So if deficiency exists, may require a combination of increasing available capital and reducing its risk level and economic capital requirements, right? And that's talking about selling off tails and stuff. The main thing, the whole point of this chapter is both for banks and insurers, do they have enough money to pay for claims or their bad investments and those type of things? That's really what it's going to, when we talk about the financial risk associated with this. And again, real simple, property casualty insurer with MVS with excess capital. We have economic capital and we have excess, and we have our market value surplus is basically the combination of excess capital and economic, right? So they kind of spend a lot of time on this in the book. You're not actually really going to see a whole lot of questions on this. And I think this is where people kind of get a little more worried and about what's on there, just because it is a little more complicated and things that we don't deal with as often. So, advantages, disadvantages of economic capital analysis, and this is really where usually you also get questions. Why are we paying attention to this? The advantages: focuses on attention on risk related to organizations' activities and helps define risk tolerance. Places value on an organization's overall risk, actually quantifies it, right, by doing this. It can help establish capital needs, right? If we understand what our potential losses are, of where we need to invest money, it'll give us an idea of where we need to actually make sure we have more reserves. Reveals capital requirements for different operations and improve allocation. Helps organizations understand economic capital position, inform investors, rating agencies, and regulators, right? And it's a quantitative measure for ERM program. The main advantage, really, when you look at this, is that if you understand where your risk, where your liabilities, where your potential losses are, it's a better, we're talking about optimization, right? Risk optimization. This is where it comes into play, because now we're using our resources and capital for those things that will have the best potential use, as well as ensuring that we have enough money to pay for if something goes bad. And that's really where economic capital analysis comes into play. Disadvantages: complex and sophisticated. I think we get that from reading the chapter. This is one of the hardest things to explain, and also just to read, right? And there's no expectation after doing this class that you would be able to do this on your own. This is probably a couple semester course in college to really actually do this. Relies on underlying assumptions and probability estimates. And then also the other disadvantage: fair value analysis to assess all assets and liabilities at market value may produce changes in MVS related to organization's ability to operate. Right. So when we talk about some of the value of surplus, an example is if you have a building, you count that as an asset, but that doesn't impact your day-to-day operations, right? It has, how liquid is it? Can you sell it? The price of the property, all those things. It can be overestimate potential assets to be able to pay for claims. Yes, could you sell it? Absolutely. But so there are some disadvantages to it as well. Solvency II and capital requirements. And this basically kind of goes just to understand that Solvency II is within European Union. It's more on the insurance side, and that there's 3 pillars associated that has quantitative requirements for capital based upon insurer specific circumstances. They actually do require economic capital that would ensure 99.5% probability that insurer would meet its obligations over the next year, right? So that's a huge capital requirement, essentially meaning that they have tons of economic capital to pay for claims. They are over, the premiums that they're collecting. That the ability, if someone can't meet that kind of goes back to the too big to fail. That the European Union through Solvency II is really ensuring that they will be solvent. Sets requirements for insurers' internal risk management process and for supervision of insurers. And there's a focus on reporting, disclosure, and transparency of risk assessment to public and regulators. Main thing you usually get questions: Basel for banking, solvency is the other one for insurance. And strategic risk, done with the financial stuff. Strategic risk is fairly simple, straightforward. Strategic risk management, a discipline to achieve an organization's strategic objectives, and cannot be applied to strategic risk, right? It's kind of weird how they word that. But strategic risks are external to an organization and are considered systemic risks outside the control of any individual organization, but also include speculative risk, which can be both positive and negative. The 3 major strategic risks, this is the main thing that if you get an exam question, is understand that's economic environment, demographics, and political environment. So when they're talking about strategic risk, it's not specific to the internal strategic, it's really the external. So obviously with elections, that has an impact. The economic environment, tariffs, all those type of things can be strategic risks that need to be addressed. So the economic environment which the organization operates can affect an organization's results, right? Examples they provide in the book as well. Gross domestic product, GDP, is the economy contracting or expanding? Inflation can certainly have an impact. Deflation can require price cuts. Inflation can increase production costs. Financial crisis. Sovereign debt crisis, access to credit. So examples, we doing business in Greece many years ago. Obviously, Greece, we don't hear about as much, was basically almost as a country was going bankrupt. They, with the European Union, repaying debt, and then whether Germany would help out. All those things have an impact in other countries of whether you want to even do business in them based upon the economic environment, international trade flows and restrictions. Tariffs and international agreements, of course, in 2018, we're dealing with all the discussion about tariffs, as well as NAFTA being redone, TPP, all these different trade agreements can certainly have an impact the economic environment and the strategic risk for an organization. Demographics, aging workforce, life expectancy, fertility rates. So when we talk about that pool of skilled workers, pension fund issues, retiree healthcare obligations. Again, a lot of these are systemic as well. Japan, some countries where they're just not having as many kids or children are being born, right? Their families are much smaller, that they're not having children. All those things can impact workforce issues, and as well as what products people will buy. You also have the more third world or countries emerging to where they can't actually buy products, and so that also the demographics of actually increasing markets and shrinking markets for products as people buy more luxury goods. Increased taxation or reduced government funding can also have an impact on the demographic issue. And then finally, political environment, right? Political risk is government action. And when we talk about defined as any action by government that favors domestic or foreign organization or poses a threat to a foreign organization. Examples, war, seizure of property, regulations, right? There's certain countries where, like Venezuela and some others, where they have actually seized assets of private companies. And so that is a strategic risk for an organization of whether they want to operate there. And then again, there's different regulatory schemes, the political environment of who they elect, in different countries. All those things, when we talk about, can have an impact on an organization, and they need to include that as part of their risk assessments when they start looking at strategic risk as part of that. So, wow, we got through it, and I think the full 90 minutes here, almost there. So lots of information. Don't get too overwhelmed with this chapter. I would focus more on obviously the operational risk, on the financial risk, the credit market, and those. The main questions you are going to most likely see is, like I said, on MVS and other stuff, is me really applying the formulas and just understanding the overall context, and you'll do just fine on the exam. All right, thanks everyone, and we'll see you next week.